Axel, we're going to talk about, broadly speaking, your commentary around the late 90s. You're out there in Silicon Valley, so I want to hear what you have to say about that. Before we do that, just talk a little bit about the decline of gold that we've seen, close to 17% since late January. Why, in your view, has that happened?
So great to be with you. First, just to be clear, gold is up about 4% year to date. And so, yes, it's off its high, but it's still up year to date. And it's been moving somewhat in tandem with the equity markets. Gold has a correlation that's near zero in the long run, and it morphs in and out. And the reason, in my assessment anyway, why it has been moving in tandem with the equity market, because the equity markets have been hostage in some ways to the bond market. What's been happening with the war in Iran is that bond yields have been moving higher, but because the market is taking this as a shock rather than a structural change, inflation expectations in the long run, as priced into the markets, haven't changed much. And gold ultimately competes with cash in the long run. If your purchasing power of the currency is held in the long run, why do you hold gold? If you think it's going to erode, then you might want to hold gold or something else. And so when real yields move higher, long-term real yields move higher, it's a headwind to the price of gold. And that's precisely what's been happening. Of course, in the run-up, in addition to geopolitical factors, there had been a bit of a speculative push into that. And so the Iran war increased risk, and with that, people reduced leverage. That being another driver here.
Axel, I feel so manic when I think about kind of our environment. You know, it's the AI spend and all the money, and, you know, it pushes certainly the equity trade higher, and you look at, you know, various names, but then you've got geopolitics, the war, higher energy prices. I'm not quite sure what this environment really is. I'm not quite sure what the underlying fundamentals. We came off of earnings and everybody's like, this was a pretty good quarter, you know? And so how do you see it? Remind us how you see the underlying fundamentals.
Well, if you're not confused, you haven't been paying attention. I suppose that's one way to frame this. The one thing I like to remind people is that gold in particular has not changed. It's the world around it that changes. So if you're looking for calm, then look at gold in terms of ounces, not in terms of how the market prices it every millisecond. And so that might get you to sleep a little bit better. But clearly we have a lot of cross currents happening. The investments in AI are real. Deregulation is real. The policy uncertainty layered on top of that is real. The tweet coming out of the White House that's changing the narrative every 5 seconds is also real. And so what I try to encourage people is have a process. It doesn't need to be a good process, but have any process. That's one way to keep your sanity. And then the one best test to see whether you're overexposed to anything is whether you can sleep at night or whether you have a sleepless night. That's probably a much better metric than looking at the beta or some abstract Greek alpha term as to whether your portfolio is good or not. You just got to be okay with what you got. And at the end of the day, if you spend less than you're making, then you'll be all right. And so then you can handle all this volatility. It's probably more than you wanted to hear as an answer, but that's I'm sticking to it.
I do, but I like that. I like that way of thinking about things. Axel, I promised we'd talk a little bit about your view on the macroeconomic conditions. And in the notes that you sent our producer Talia ahead of time, I was really struck by what you said. I'm just going to read right from it and have you expand on it a little bit. You say it feels like a variation of 1999, but it feels difficult to say whether we are in 1997, 1998, or 1999. A key difference is that the late 90s boom was mostly driven by risk capital chasing the dot-com story. Many people, and we're going to talk to one of them in the 4 o'clock hour, Ed Zitron, who's very skeptical of AI. People would argue that what we're seeing now, maybe there are some corollaries to the late 90s. Instead of .com, it's AI. Maybe people would push back and say, well, these companies are profitable, some of them. What's your view and sort of like, why do you think we're there?
Do you find any, can I just throw in that what Alphabet did today as an equity raise and not debt, which seemed to put some comfort in the debt markets because they were using equity this time around. So I'm just,
yes.
Yeah.
So Yes, so definitely. And the one thing you guys didn't finish earlier is, right, the difference is nowadays a lot of debt is being used. And of course, it's somewhat of a everybody is feeding on itself. And so if that music stops, then there could be an issue. When there is an enthusiasm and it's equity financed, that's risk-friendly capital. If that were to come to an end, well, it will be sad, but it's not the so-called systemic risk that regulators should be at least concerned about. Whereas in 2008, of course, it was a debt binge in housing that caused an issue. And so the question is, are we going to cause some sort of systemic risk with too much debt in the bond market? And in that sense, yes, absolutely. When capital is being raised, massive capital on the equity side, that's a very positive sign. And so, and then of course, yes, some of these things are profitable. That said, one big difference, maybe not to 1999, but to 2011, when Mark Andreessen came out with his talk about software eating the world, and I think I said this last time I was on your program, is that nowadays AI is eating software.
Right.
Huge investments are needed. Margins are uncertain. And because I'm a precious metals guy, I got to add that, well, on the precious metals side, investments are also very significant, but margins are very good. And so in that sense, I think you guys had the story out earlier today that all the money is moving to AI. Well, a lot of money is making it to industrial investments as well, in part to support the AI boom. But that is very different from a market just focused on software in the late 90s or in 2011.
Okay, interesting. So, should I say it? This time is different?
Well, there is still the enthusiasm that investors have, and that will work until it doesn't. And I'm an optimist of the AI boom, but at some point there will be an awakening because not everything is going to be profitable. At some point, valuations will be perceived to be too high, and because we've gone up so much, well, on the way down, you can go also down quite a bit. What I tell people on the precious metals side, and it's the same on the AI side, if something goes up 100%, well, let's say 50%, well, you can go down 50%. I mean, usually 100% down is of course down to zero, but the volatility is there on both sides. And so what people may want to do is diversify on the way up. Now, what you diversify to is, of course, another question when quote unquote everything is up.
Yeah, I mean, look, I'm just saying Hewlett Packard Enterprise up 19% today. It's up 132% so far this year. It's only June. And, you know, you look at the chart and it looks like a hockey stick.
Yeah, it looks like everybody's a gold mining investor these days, right? I'm used to those swings, and on the equity side and the junior miners, it's not so common that the traditional equity investor gets to experience that, and of course the difference is that the gold mining investor tends to attract more the speculator. They should at least be used to the volatility, whereas on the S&P 500, people have just been blindly buying it. And if their portfolio is suddenly much more volatile than what they sign up for, they're not going to complain on the way up, but on the way down, they're going to cry foul. Hey, nobody told me about this.
Hey, one thing we want to ask you before we go, we just got about 40 or 45 seconds, and it came up in your notes about Bill Pulte being named as acting director of national intelligence. Why do you think it was important to include in your note? And we've just got about 30, 40 seconds here.
Well, because the Fed is, Mr. Walsh is in a pickle somewhat, that you have every Fed governor is speaking out what they want. Walsh said, hey, talk less. And then also there are some internal tensions going on with Chris Waller trying to reform how the regional Feds work. And so Pulte, he's the one who's been antagonist at the Fed, both going after Powell and after Cook. And so he is certainly not being sidelined, but maybe his disruption is needed elsewhere now.